Whenever it's possible in my finance fundamentals readings and videos, I make a strong recommendation that you try to adopt a logical timeline-based approach whenever you can. In situations such as this, where we're working with a cost of trade credit, yes, there is an equation available to you, and assuming that you have successfully memorized that for the exam, you could always apply that. But it is far more reassuring, in my opinion, and more powerful to have transportable techniques using very basic time value of money principles to do the necessary calculations. Let's look at the example on the screen in front of us, which is talking about credit terms of 2 in 10 net 60, which mean that our company has been offered by its supplier the opportunity to take a 2% discount as long as it pays the invoice within 10 days, or alternatively, it must pay that invoice in full without a discount within 60 days. The most important starting point for this consideration is to understand that early payment must not be made by the company. If it is within that initial 10-day period, it should most certainly not pay early, such as on day 6, because that would mean that it is allowing cash to leave the company unnecessarily early. So within that first 10-day period, the only logical consideration is to pay that invoice on day 10. If we assume that for whatever reason the company has allowed that initial 10-day discount period to pass and it's within the second part of the timeline, it should not pay that invoice early on day 20 or 30 or 50. Once again, the only logical time to pay that invoice once the discount has been lost is on day 60. This means that the relevant part of the timeline is the period between day 10 and day 60. Dealing with this on a logical basis is quite easily achieved by assuming a notional amount of 100 Rand for an invoice. If the invoice amount is 100 Rand and we have the choice of taking the discount or not taking the discount, the 2% discounted amount on day 10 would be a payment of 98 Rand. And what we have now, given that the period between these two amounts is 50 days, calculated as 60 minus 10, we need to establish the discount rate that links 100 Rand 50 days from today to a present value of 98. And that discount rate is calculated using the standard TVM equation, which links a future value with the present value given a time period. And in this case, we have 100 divided by 98 to a fractional exponent of 365 divided by 50 minus 1 equals a discount rate of 15.89%. That is all you need if the examiner's asked you to calculate the implied cost of trade credit given the situation. However, you are also likely to be asked, given a borrowing rate for your company, should the company take the discount or not? If we assume, for example, that the firm's borrowing rate is 12% expressed on an EAR, effective annual rate basis, that would mean that the cost of not taking the discount, which we have calculated as 15.89%, is greater than our firm's borrowing rate of 12%, and therefore we should take the discount.